Just to tell our viewers that any statement here by our guest is solely his opinion and that of, not that of Proshare, setting that context. And once again, it's great to have you, Mr. Abubakar Suleiman. As a banking CEO, as a bank CEO, and C-suite business leader, I'd like you to share from your environmental scanning what you've seen around the current economic and geopolitical developments as it impacts banks and the larger sense of economy.
Thank you. Over the years, we've gotten used to expressing our concerns about the economy and the factors that are coming. So every time we have a board meeting, there's always this little presentation, and we talk about how we expect, headwinds. This accelerated during COVID, and from 2020, there's not been a year where we were not spectacularly worried about headwinds. And then I had a meeting with my team this year, and I said I actually expect some tailwinds. And that was contrary to everybody's expectation. And the reason is that we've got all of the trade wars that is brewing. We've got the actual war that is going on in Ukraine and some of the other things we're worried about. We've got the US really calibrating its engagement with the world. And so people thought, oh, yeah, then you must be very worried. And I said, no, to the contrary. And the reason is that most reforms, most significant reforms happen under pressure. The idea that you're in a comfortable place and you take big decisions is not one that we can count on. There's no evidence that suggests that. Look at the support that we're getting from NGOs in the US and what it did for the health sector. For the last 10 years, we've continued without making any significant reform to the way we approach public health or even health reforms. But suddenly now we are waking up to a significant reform. So I'm of the view that when you look at changes, they happen during difficult periods. We're not necessarily praying for it, but when it comes, we take it on. We think that Nigeria has a huge opportunity in the shadow of all of this conflict and all of this restructuring to make some significant moves, and I'm seeing evidence of that.
Very interesting. Before I allow my chairman to make his input, I've noticed that in your Sterling Bank there's this thing called the HEART.
Yes.
Health, education, alternative banking, then renewable and transportation.
Yeah.
No wonder you started with healthcare.
I think we have to be clear. Without health, there isn't a lot more to be done. We understand it at the individual level, but we forget to understand that the collective, that if the nation is unhealthy, there's really nothing else that matters. I mean, just think about what happened during the first few months of COVID. We were all struck down. Nothing else was important. We weren't even thinking about infrastructure or any of the other exciting stuff. You just have to be healthy. And from a business perspective, we think that the most difficult problems to solve are medium to long term, the most profitable problem to solve. Because they are difficult for a reason. They are difficult because there is opportunity to create new value. Existing stream of income is not going to make you successful in healthcare or agriculture. You've got to think differently. And because they're difficult, there are few people doing something about it. So if you do it, you actually do have a competitive edge over anyone else coming after that.
Yeah, yeah.
I want to acknowledge a keyword you used. You said there's going to be tailwinds. I agree with you. I also believe that as an organization, we focused in the last 3 years about what is positive about the Nigerian state. I know it's easy to talk about the negatives, but we have made a conscious effort to always focus on what is positive. And two things we did was to take a look at the rebasing ourselves, using all the metrics, and we also engaged the body, and I'm hoping they will come out with, so we see some positive indicators. We also developed the Nigerian economy to 14 subsectors. So we call sub-economies. Rather than look at sectors, we looked at them as because of the linkages. And that is really why I wanted to ask this question. In your understanding of the geoeconomic trajectory that we face and the kind of reforms that we have taken in Nigeria and the uptick we have seen currently, how do you think we can sustain that and achieve a better productivity that helps every other person? How do you think we can?
I do like the approach of looking for what is positive and what is possible, because that's also the only place where you can make a difference.
Correct.
I think everyone can analyze what is wrong and what hasn't happened, and we've done a good job of that without necessarily progressing. So I like that approach. What I worry about is that increasingly the power to reform this country lies with the sub-sovereign. We always look at the federal government and its capacity for reform, and we should not stop that. But let's remember this, no less than 60% of public resources is no longer with the federal government. Somewhere between the state government and the local government, especially now that we've now had some enforcement of we're ensuring that the resources are getting to the state. And so to the extent that these resources can get to the state and we are not trying to create reform at the state level, there's only so much the federal can do. But if we go back to what the federal can do and is doing very well, one of my favorite reform over the last couple of years has been NEL Fund. I've always believed that you cannot run a country where the total capacity you have to educate people at tertiary institutions is no more than 400 to 500,000, and you have 2 million people constantly showing up for it. That, for me, is an anomaly, especially if you are doing it for free. We therefore needed a model where we can accommodate more people even if they have to pay back, right? If all NEL Fund achieves is for us to double the number of people who can access university or tertiary education, but they all have to pay back something, it's better than having half of that who pays back nothing and the other half who gets dropped off, right? Those are the kind of reform that I like at the federal level. Very specific reform, very precise reform. I also like the reawakening to infrastructure, specifically logistics, because we have a primary problem in this country that dovetails into everything else. We have food inflation as our primary problem. And every time you have food inflation, what then happens is that it drives up interest rate in the country. Because obviously food inflation pulls up all other aspects of inflation and the interest rate is high. Once that is high, that is capital that you are restraining. At 35%, there's only so much debt capital that can go into the economy. At 25% or at 15%, suddenly there's a huge amount of capital, domestic capital going into the economy. So I like anything that reduces food inflation. And investment in road infrastructure is one significant part of that. If we do that successfully, given the success we've witnessed with exchange rate, where there's now a lot more predictability, there's a lot more investment. We are in an economy now where I can get the capital I need for a $20 million capital investment in manufacturing in 48 hours. A year, maybe 2 years ago, I would have had to wait for months to be able to access that amount of FX. We're in an economy now where all of the money that was due to the airline has been repatriated. What that does to business confidence is that you know that when you make a commitment, you make an investment, you get your money out.
Is it not therefore a contradiction on your part when you say that, yes, we the subnationals and whatever should do anything, but yet we don't need the government to do anything? When in actual fact, every single example you cited here has been because of the government. My question therefore is this. We need a GSM type moment. If we therefore want to get there, yes, the way it is structured, it only comes from a singular policy position and then get out of the way. Yes. Is it that I did not get you correct there? And what you're just saying is that government should just stick to their own aspect of it and leave the playing field for maybe that's what.
Okay, so there are three key players that I'm looking at. Okay. A lot of our attention goes to the federal government, and rightfully so. But I'm saying that the state government should play an important role in reform. Specifically in reform in the agri sector should be primarily a state government-led activity, not a federal government-led activity. They own the land, they control the population, they effectively should put in place the required infrastructure for agri to thrive. Same thing with primary education and primary health care. These are really fundamental part of building an economy. So I'm calling out the states that we have not seen a commensurate reform at the state level, or at least not one that is commensurate with the amount of resources they've gotten from FACT. Now, for the third layer, which is also the private sector, my view is that the government has invested far too much in regulating industries that have barely taken off. And so rather than allow what happened with the GSM, where in the early days, if you think about the GSM in the early days, there were very few restrictions. You guys could charge anything for the SIM card, they could charge anything for the call. But that created a profit pool that led to massive reinvestment and also massive, exactly, interest by investors. And now, once the
other economies.
Absolutely. Once the investment is significant, then the price regulation is actually self-regulating. People would remember when per second billing came in, it wasn't a government regulation, it was competitor-led. So I would want the government to understand that every single time that they create a toll gate of bureaucracy, they slow down the economy. The government acts as a brake, but you should allow the vehicle to take off before you start to step on the brake, right? Right now, the government needs to act as an accelerator. They need to give agencies requirement to drive growth rather than just compliance requirement. That's what we need at this phase of our development.
Great point.
Very interesting open conversation, especially clarity on policy and investment. Of course, a lot to unpack. But I would allow you to test. You want to talk about the macroeconomy and the banking sector?
Yes, Otto, thank you very much. I was quite interested in what Mr. Abubakar said because I feel he was trying to draw a link between the headwinds that might be occurring in the sub-regional levels and the household. So it's not just about the sub-regional governments, but it's also the household. And the tailwinds that we might be experiencing, actually at macro levels, where you're seeing improvements. Our credit rating has gone up, right? So that our costs of perhaps borrowing might slightly decline, and the confidence has risen. That's good. But in terms of banks and banking, what specifically should the banks be doing at this period of time, given the positive sentiments that we're seeing at those macro levels and the challenges we're seeing at the sub-regional and the household levels? What really can banks do?
So one of the positive outcomes from the reform that we've seen is that the banks have reasonably increased their capital. The capital process is not complete, but from what we've seen so far, there's every likelihood that all the banks would actually end up raising the required capital. And that's a huge, huge, huge progress at a time like this, right? Even we in the banking sector, we're not sure that we're going to be able to complete it within the time that was given. So that's something to count on. The second point you've made is that there's a level of price stability and rating enhancement that also improves our ability to access debt. So we now have equity, we now have access to debt. Now the point is, where do we direct this? Should we be directing this towards the consumer, or should this be going primarily towards the producer? Unfortunately for us, for as long as the lending rate is this high, it is very difficult to focus on pushing debt to manufacturing, for instance, or to anything that requires medium term. It makes sense for short term, so you would see debt will go into trading, import, or even export. These are short-term transactions that you can come out of. But you're not going to lend to someone at 30, 35% right now for a 5-year infrastructure project. That itself becomes a problem. So what are we hoping for? We are hoping for further reduction in inflation, which will then equip the central bank to begin to think about a lower interest rate environment. From the asset side, it is very difficult to massively grow your asset at 25, 30% interest rate. It is, to my mind, has a potential risk of people piecing away the capital that they've raised if we don't think about it carefully. However, there is opportunity on the consumer side because the household is also not highly leveraged, right? So there is a need for us to begin to figure out how to get credit across to household, hopefully cheaper. Because the reason why we end up pricing household at 40, 50%, it's because we haven't fully understood their credit, and the way the lenders have solved for that is to price it very high so that irrespective of what happened. But thanks to technology, we're getting a deeper sense of who is a good borrower and what can we do about it. Not just technology, some of the reforms in the financial services sector, like the credit bureaus that have now matured quite a bit, the GSI, our ability to effectively recoup or recover money that may have been stored away in other financial institutions. Those are things that are helping us understand the consumer better. the consumer needs to be able to take on more leverage to drive demand. That would then make it easier for us to finance producers to meet the demand locally, right? The key is to make sure that you don't finance consumers such that you end up triggering import. You need to be able to do both sides. So you get both import and export, and then you get growth.
So that question, I think, is incomplete because, okay, so we're excited about the capital raise. So you think we expect more funds to go to the private sector lending. Well, how do we get excited about the capital raise when we still keep the CRR at such levels?
Yeah, 50%.
No,
Yes.
I just really needed to ask. And I'm very...
I was about to ask that as a
No. I mean, you cannot have a conversation with the banker today and not talk about CRR, right?
Yeah, because I just want to understand.
So I will try to, I will express what I think is a balanced view. I would rather have a relatively high CRR and price stability than for my CRR to drop and I start to suffer runaway inflation, right? If those are the options presented to me, even as a business person, not even as a regulator, because what price stability does for me, yeah, because the other view, to go to the regulator's view, is simply to say that the banking license that you own, right, contracts you to support whatever policy without an explanation. The balanced view is to show how there is an economic reason why that particular policy decision is right. And that view is, can I get price stability today without relative much higher inflation if my CRR was to be reduced?
Can I add a little mix to it? So if you, let's assume you keep the CRR at that level, isn't that the purpose of actually telling them what you actually do with the money is to make sure that I want you to target these particular sectors exactly with that?
So I do believe that some specific sectoral targeting for credit is a good idea. And I like to think that that's kind of the sort of thing we would expect in the coming days. But in the first instance, we needed price stability. Like we would do anything to get price stability, because what was happening was that we couldn't retain deposit in the Nigerian banking sector when devaluation was happening at a certain level. Okay. Every single saver would rather take their money and convert to USD. If I need a 25% interest rate for me to stop that flow of capital, I mean, we got to a point where even people who have never left the country were already converting their asset to foreign currency. That's a high level of dollarization that we could not stand. I do not like a 50% CRR, but I'm willing to pay that price to stop that dollarization process, because then I can grow my domestic deposit book as opposed to a foreign currency book, which I struggle to lend because there are not many businesses that generate foreign currency. And the good businesses that generate foreign currency could access international capital at a much lower cost than my cost of capital, right? So again, I look forward to when the CRR will begin to taper down. But given that I've gotten foreign exchange stability and I have predictable interest rate regime, I think it's a good start. I think we should just then hope for the next step.
Quickly, can I ask a question? Now, your view is interesting, very interesting. I want to ask, how does the recapitalization, additional capital, come to play in improving the ability of banks to extend credit? Most people see that as the capital as a buffer to absorb shocks, but can it also be used as a tool to extend credit to those?
So you're right that in some cases the capital will add as additional buffer, and that's understandable, especially for places where the capital adequacy ratio were not already robust. So that makes sense. But there's no way you're going to take in incremental capital and not grow the business incrementally, and you'll not be able to reward the shareholders, right? So the embedded in the capital raise is that you've got to do more business, and more business is not just to take deposit. It will require you to do incremental lending, right? Luckily for us, a lot of the really good businesses were already struggling for incremental debt, right? Once you see a high inflation environment, they just need more debt, even if it is just to do the same business. And many of them, when the exchange rate harmonization happened, realized that they had a lot more domestic demand, and therefore they needed to expand. So I do see ways to extend credit to the economy today that would drive domestic production, that would not necessarily lead to additional importation of consumer goods, right? So I see that as one area of it. But the other one is that I think a lot of the consumers are accessing incredibly expensive credit from sources that obviously are not well regulated. I mean, there are people whose access to credit is 60% or 100% per annum. Those are the kind of places where, as banks, we must begin to extend credit to reduce that cost to the consumer.
Okay. If you check your first assessments, healthcare, education, all those infrastructural development, both soft and hard infrastructural developments, are the banks the most ideal source of funding those infrastructures?
Okay, so that's an interesting question. Most Nigerian businesses, when you ask them about access to capital, they only think of banks. And there are a couple of reasons behind that. At the early stages, we do not have intergenerational equity. We have not transferred equity across multiple generations, so the savings ratio in the economy is low, and the capital formation is still at an infancy. So we don't have a lot of money from grandparents to build businesses. But most importantly, when they move into setting up business and they are ready for growth, we don't have the governance that will lead you to the capital market. So the demand for governance at the capital market is way higher than at the money market. So people think of money market as their only source of financing. And what we are now saying is that until you build that governance, you can't go to the NGX. You can't go to SEC and say you want to, raise money from the public, right? So are the banks the most ideal source of capital? In many cases, no. But if you look at the context of Nigeria today, sometimes the banks are the only available source of capital. We now have the pension funds that have come on board, but the pension funds themselves require the right type of asset. And primarily, most of the assets that the pension fund will invest in has to go to the capital market.
Right. Markets.
Exactly. So this is us making do. I've always believed that the banks carry more than their fair share of weight in certain areas. I believe that it's time for us to begin to see other sources of capital. We've seen it in the tech ecosystem where venture capital and private equity came on board, and that made a huge difference because those are capital that were formed to take risk. They were formed to take a higher amount of risk than the banks can take, and therefore they could lend in places that the banks dare not go to, right? And we need more of that. We need risk capital to come on board so that we can then build up the businesses to come to the money market and to the banks.
Okay.
Very, very, very interesting. The risk capital, I like that part. So let's look at stablecoin, and of course, in the United States of America, we're seeing some developments around the Stablecoin Act. But I just want to ask, for Nigeria, how are the banks going to align and begin to adjust to this kind of development? Because we already have the Investment and Securities Act 2025, which enables the Securities and Exchange Commission to regulate digital assets as securities. So what's your view on the whole thing around stablecoin?
So the beauty about being a highly regulated entity is that you wait for your regulator to lead the way.
Yes.
We have a couple of crazy and interesting ideas, but they are no use until the regulator sanctions it, right? So I would like to talk about stablecoin in the context of our own central bank and reserve banking. I've always believed that, be it cryptocurrency, like Bitcoin, or whether it is stablecoin, they are more a competitor for the US dollar than they are for any domestic currency.
Correct.
And now, increasingly, there can be a competitor for precious commodity like gold and silver, because people assume that they can store value safely. So what should I be doing as a central bank, or what should the central bank be doing? It's revisiting their portfolio of assets that constitute their reserves and asking if there is any reason at all to extend beyond the current portfolio. Right now, they have the US dollar, they have a couple of other currencies, they have gold in their reserve. The question for the central bank is there a need for us to extend that and include other asset class? That's a difficult one to answer, but it is primarily a conversation around risk management, not just about value management, right? And I'm confident that they will make that decision, because that then determines what the commercial banks can do regarding those currencies. Now, stepping away from stablecoin and cryptocurrency as part of a reserve pool, if I think about it on the payment side, the question is, what can I do? Because the ultimate beneficiary for payment is the consumer. The consumer has 3 pain points that are, top of mind. The first one is they want safety, right? Whenever they are handling money, they want to be sure that it gets there. The second one is they want instancy. They want the money to be delivered instantly. And the third one is they care about the cost. The technology allows us to achieve all these 3, right? There are other technologies that could do it, but blockchain technology enables this in a ways that other technologies may not, right? So should we be tokenizing our currency so that we can make payment? I think we should revisit the e-naira. The use cases may be different from what it was originally intended for, but I think that the idea itself is powerful, and it should be revisited with a couple of ideas. One is, how can I solve for cross-border payments? Because a lot of Nigerians are making cross-border payments and are paying too much for it, right? We do see some technology coming on board. We see, for instance, the PAPS, the Pan-African Payment and Settlement System, that potentially could solve within Africa cross-border payment for trade and hopefully for SMEs as well.
Yes.
But I think cross-border payment out of Africa still need to be solved for, right? That is something that I'll be more interested in than just stable coin as part of a reserve or as a threat to banking. The second thing that then they must then think about is, should we use the tokenization as an opportunity to begin to include other kinds of assets within the pool of assets that financial institutions can hold? And it's not necessarily a Bitcoin where you're talking crypto. It could actually be physical assets that, if you tokenize it, then allows it to be financially. So I give a good example. If you go to real estate today, it's a highly liquid asset class. And because it's highly liquid, the demand for it is low, the ability to financialize. What if we use tokenization to make real estate as liquid as stocks? Those are the kind of thought process I think we should be experimenting with, both in Nigeria and on the continent, and I think that's where the value lies for us. But finally, if there is a way to use stablecoin to increase financial inclusion, then that should be something we should think about, because we've been able to use technology to really advance financial inclusion, but there is this last mile left that is still very difficult to deal with. And part of it is because the cost of financial services is too expensive for them. They would rather take the 30 minutes and go and walk down to the neighbor and pay in cash, because the cost of cash to them is zero. Can we bring the cost of financial services close to zero? It is the reason why Sterling Bank recently decided to remove the payments, the fees for transfer. We are currently not only giving up our own share of that fee, we then pay the other counterparts in the process on behalf of our clients, because we think if we do that, we could actually see a significant increase in financial inclusion, right? And we can go beyond that. That's the kind of problem I would like to solve with stablecoin, as opposed to worry about whether it's going to replace the dollar or whether it's going to disintermediate banks. I think banking is a capability. The assets and the liabilities will change, but the capability to manage risk, to manage compliance, those are things that are deeply embedded in ourselves and our culture, and we would always bring that to the party.
At that point, you mentioned something that I found intriguing and very interesting: the removal of charges, certain charges on behalf of your customers. The question I've been faced with: is this sustainable?
Okay, so
which aspect of this is?
Whether can I continue to offset those costs?
Costs.
So I'll step back. The reason we did it, I've always believed that the technology cost to deliver domestic banking has hampered our ability to scale.
Okay.
Right? So every time you scale, your cost is in dollars, and no matter how poor the customer is and how much revenue you can attract from the customers, it still costs you the same thing to manage that data, whether it is in terms of your data center, in terms of your core banking, in terms of all of the security investment. It's the same thing. So beyond a certain point, it no longer makes sense to bank that customer. The only way to solve for that is, first and foremost, to move that cost from dollar and to domesticate the cost, and if possible, to crash the cost. So we made significant investment over the last 3 years to build out our own technology ecosystem. Yes. We build out the private cloud. We also built out a core banking application and a couple of other support applications. Now we know what our cost is. First, we know that our cost is no longer responsive to the dollar. At least a large segment of our technology cost is now domesticated in Naira. And also, we're no longer at the mercy of, external parties. And the gain from that was significant. The question we ask ourselves is, how do you turn this into something much more meaningful than just an improvement in bottom line? And the thought was that this is the way to go, right? So we've already paid for it through innovation. We now want to use that gain to create the next set of innovation, which is how can I open up the platform so that I can bring in other products. So removing the fee is a way to extend and expand our growth. But the way we also benefit from that is that we're going to then introduce products that are incredible, that would, I would say no.
Okay.
And the reason is that for the neobanks, they are the phase in their life where they are spending money to acquire customers.
Okay.
Very few of them are running this profitably. And it's understandable. That's been the pattern. You grow a platform by spending a lot of money to drive customer acquisition, and at some point you become profitable. That is useful if you can drive out other people. If you finish spending all of that money and we're all still in the same game, you're going to meet us where we are, right? So you've got to be able to drive out other people, or you've got to be targeting market that has not yet been acquired. So in the case of the ones that have been most successful, they went after markets that nobody had paid enough attention to. And so they have that market, and then they can compete with it for profit. In our own case, we're already running a profitable business, and we're thinking to ourselves, we can do better than this. What can we do such that the existing customers then have access to, say, financing, for instance, or asset acquisition, wealth management? All of those things are the ultimate game for us. We're getting rid of the irritating baseline, which is charge you for every transfer, so that we can hopefully work with you to start to access more valuable products that we offer.
So let me quickly just, because I agree with the answer to the question, because I don't think they are direct. But let me understand the competitive playbook here. So at the level of the new banks, they would go up, but when they start scaling and become bigger, they only have two options. They either go get your license, or they get acquired. So it's really, really not a key advantage for them. But within the existing regulatory framework, I felt most people accepted your decision to drop the charges. And I understood once you had EBAS, you had a competitive advantage there. Now, it's the other side I'm trying to get, because now I expect that you should have numbers and you will scale up and you'll be able to grow so big enough that, okay, your weighted average cost of funds will obviously there drop, so your margins will effectively increase. So that means you kind of like have a break-even point. Why is this something that is not caught on with other banks?
So for you to achieve that, you have to first break the cost.
Or decouple your...
You have to decouple yourself from the tech oligarch, right? If you are coupled to that, every single time there is a currency movement or there is inflation offshore, it gets fed into you. That's the hard out job. Removing the fee is the easiest part. The hard part is, can I make sure that I need to take out my cost first? I have to have that cost savings in my pocket. Then I make a choice. Do I add this to the bottom line?
So it was easier for you because you were slightly more nibbler than the...
Absolutely more. But also, it also means that my additional cost for new customer acquired, or the marginal cost for serving a new customer, is close to zero.
Yeah.
So if I didn't do that...
And your ability to adapt and adjust and...
Correct. If I didn't own my technology and I doubled my customer base, I'm going to double my cost. Then it's very hard for me to remove the fee. But because I own my technology, I'm not going to double my cost, even if I double my customer base.
So then help me understand this sequence. So the alternative bank came before this move. I believe it was all part of one single thought process.
Yeah.
What is the precise strategy here?
So I spoke earlier about how we have a deficit of equity capital in this economy, right? You've seen our savings to GDP ratio. There's the fact that the landed property, which is usually a huge part of capital in every economy, has not been financialized. So you can't really use land as part of your capital pool. And so we don't have multi-generational equity. That means the country has the poverty of private sector equity. And that's why we're so reliant on foreign capital to do anything. But we do have a reasonably robust debt capital market that is growing, where we've seen the banking books and the deposit in the banking sector, as well as the pension. So you've got to create a model that allows you to tap into some of that deposit through a partnership model to grow what would otherwise have been funded by equity. So for instance, if I was going to lend money to someone, as a bank, as a conventional bank, I need the person to come with evidence of historical evidence of running a business. So you have to have your audited account and all of that. But you also probably have to have a collateral. But there are a lot of incredible businesses out there that have neither the history nor the collateral. The only way such businesses can access capital is through a partnership model, which is where the alternative bank comes in. Where you come in as a business person, I have this talent, I have the skills, this is proof that I can do it. The bank comes in as your financial partner, they bring in the capital, you go into the business together, and you deliver outcomes. That can't happen in conventional banking because we're not licensed to do that. So you would see, and I expect a lot more non-interest bank licenses to be granted in the country. I think it's uniquely appropriate for a country like ours, where we don't have this massive equity pool to keep starting businesses.
But related to that question has always been the concern around the risk framework. So how did you manage to, I won't say the risk, to manage the risk architecture around that to create,
so
without saying...
Yeah, no. I mean, we should be willing to share experience, otherwise we're not going to grow this country fast enough. If you look at the history of non-interest bank across the world, they're actually less risky than conventional bank.
Correct.
And the reason is that if you pick up the balance sheet of any non-interest bank, every single line represents an actual asset. Every single line you see there should be able to trace it to an asset. If it is not cash, you're going to trace it to gold. You're going to trace it to commodities. You're going to trace it to real asset. That means that at every point, activity, even though you are not lending against collateral, your assets are all collateral. Okay. Right? You have an equity interest in the asset.
Activity itself is
correct. So the risk management model in non-interest bank is actually, in some regards, superior to conventional bank, right? Because the distance that we have in conventional bank between the businesses we are funding and our exposure to them, it closes out when you go into non-interest banking. You've got to have a real first-hand experience. If I'm lending to someone who is in the agricultural sector, I am a part owner in a farm, or I have commodities in a warehouse somewhere that I have checked that is partly mine because we're in business together. It's a lot more work, it is a lot more intensity, but it's lower, it lowers the risk.
Okay. Yeah, I'd like to ask something about that. It's very interesting. I think it's an absolutely brilliant initiative by Sterling, actually. An alternative bank was needed. It's a concept whose time has come. However, I'm concerned about, as FA had said, how do you, in my instance, is de-risk it? You're correct that you could be invested in agriculture, for instance. Let's take that as an instance. And suddenly there's this flood that's happened recently in the Middle Belt. So how does let me say an alternative bank protect themselves against such eventualities?
So I'll address a specific example, then I'll give a general explanation. That's why you have Takaful.
Okay.
So for instance, you have North Takaful, one of the best non-interest insurance company in the country. That they also have created insurance product that perfectly matches the alternative bank's product.
Okay.
So it's not, that exposure is covered.
Okay.
And it's no different from the exposure of anybody who is in risk sharing, anyone who is part of the risk and part of the reward. Right? So that's part of it. The second part is that because you do risk sharing, usually your returns are higher, and that gives you a pool to be able to absorb risk when it crystallizes.
Okay.
So that would be the general thought process. The specific one, I mean, that's specific to that example, but the general thinking is that it all comes down to skills and talent. And because this is a sector that is very new to the country, there is a need for us to invest significantly in building the skills and talent. And what we've done in Alternative Bank is to create an alt fellowship where we are hiring hundreds of young people every quarter to go into a program. We build digital and learning platform. They do online learning, but they also have physical insertion. And so we are going to be graduating a lot of young people who then have the skills to participate in non-interest banking. So without the talent, the sector will be weak, and we're investing in that.
That's quite laudable to see what you're doing with the alternative banking and also what you're doing with the enhancing financial inclusion, because when we talked with the enhancing financial innovation and assets, they said that was a laudable step to take, and we'll continue to track these developments. Now, let's look at the recapitalization. 2026. How is Sterling Bank looking at positioning itself? Because we're looking at banks being bigger, bolder, and brave to take on competitive advantage. So what should we expect in terms of the modeling and overall for the banking sector? Okay, so the good news is that we have three plans. We had three capital plans, mini capital plans that would end up with us having all the capital we needed, and we've successfully completed two. We did a private placement last year that we concluded, and that has been done, and we just rounded up our rights issue, right? And so we have one more capital round to go, and that is an offer. And we went for an offer because we want to diversify our investor base further. We think that the more people who are invested in the business, the more goodwill we have out there. So we want some of that. But regarding how the strategy of the group, we are more concerned about diversifying our risk. We don't worry as much about revenue. We think that for as long as you remain creative and you're solving problems, the revenue side can be solved for. What you must watch out for is where it becomes so concentrated. And so now we've moved from having just one bank, we have two banks. We just launched an asset management company, Sterling Wealth Management. And we think that over the years, we will continue to diversify within the financial services and within the products that we're allowed to do under the holding company. So that diversification is important. So we're not wholly dependent on the bank as a revenue source. The other game is we've always believed that financial services is increasingly ability to build technologies that can reduce your cost and increase the customer's convenience. Like that, anything you do in financial services, every other thing will be vanilla. Every product you create, somebody else is going to create it. There's nothing you can, there are no IPs you can create on the product side. So your IP is going to be on the platform side. It's going to be on the partnership side. The more you build deep partnership, the more likely that you will retain that ecosystem value. And so, yes, our perspective is that let us continue to own our own technology IPs so that we can serve our customers better and can serve them cheaper.
Quick question there from what you just said. How does this playbook differ from the universal banking era, 1999-2000, where we shifted to universal banking? Are we going back to the future?
I would say the significant difference is the regulatory framework, where it is no longer just the bank doing universal banking. It is that the bank would do banking, but an Investco, which is your holding company, now has the capacity to own investment in other sides. This is important because it provides regulatory clarity. You can hold the bank firmly accountable for complying with the central bank rules for the license that it holds. We can also hold the asset management accountable for complying with the SEC rules that it is governed by. And you can also ensure that there is sufficient process in place to protect the depositors who are in the bank, which is the critical role that the central bank is concerned about. How do we make sure that the depositors' funds are protected? So, yeah, it's a little bit of back to the future, but I think it's a much better model that allows us to take advantage of universal banking, which is important for the economy, without taking on risks that are not managed.
I worked on that concept a number of times, which actually shows me I'm very old right now. Here's the thing I want you to help address. It has to do with inter-regulatory agency workings. And I agree with the structure. We now have a holdco company, but which is basically licensed by the central bank. So I've seen situations where insurance companies have issues, and yet the holdco can put out their final result because they haven't resolved with NICOM, for example. We also see the other aspects of which fall under separate regulators. So without us using the UK model of the Financial Conduct Authority of the and we use the central bank model, which is still the same old model, do you envisage that there would be the need for us to have a shift in how we conduct the holding company strategy going forward?
I do. I think the holding company needs to
it's basically an asset management company.
It's an investco.
Yeah.
It needs to start to function as a company that does investment. And to that extent, it's liable to its investors only.
Exactly.
Right? If we do that, it allows that to be a source of capital accretion. We need companies that can attract capital. This country needs domestic companies that can attract both domestic and foreign capital, and to be able to distribute those capital in equity form across multiple asset classes and across multiple industries.
Yeah.
From a development perspective, this is what I would like to see.
Exactly.
And that requires us to ease the amount of regulations on the holding company, and maybe even increase the regulation on the specific
subsidiaries
those are the operating entities.
Exactly. I'm happy now.
Very, very interesting conversations.
Just let me chip in there.
All right.
We at Proshare, we've concluded our Tier 1 banking report, 2025. We have the class of 2025 now. And I'm going to go back to what you've just said. Now, there are holdcos and there are holdcos. And let me put it in this context. You have holdcos with a dominant business in Nigeria. And then you have some holdcos. The dominant business, I don't even know which country. So I don't want to mention the holdco, but it's not really a Nigerian holdco, right?
Correct.
Now, that entity is listed on the NGX.
Yes.
The subsidiary is not.
Yes.
So trying to compare holdcos for us became a bit of a problem. How do you think we can resolve these kind of challenges?
I think it's always difficult to compare global businesses with domestic businesses. Right? It's always been, no matter what. I mean, for instance, how do you compare Citibank in Nigeria with any Nigerian bank, even if they're both just banks?
Yeah.
Because it represents a lot more than just the Nigerian business. It captures brand value that we cannot begin. It captures network value. So, right, how do you place a value to that? It's very difficult. So I understand your difficulty. But there's even a higher level of difficulty when you are comparing a capital vehicle that is domestic, attract domestic capital and invest here, and what I call a consolidation vehicle, whose sole objective is not capital raise, but simply to pull together the different businesses. Right? So the objectives are very different. A holdco that is consolidating the subsidiaries of an international company is not a capital vehicle. Primarily, it would raise capital from a mother vehicle offshore, right? So its audience is different. Even if they are listed on the exchange, the primary audience is different. So I can't solve for that complexity. All I can say is that always put a footnote. That, they may look alike, they're not exactly alike.
Thank you. Very, very interesting. We just want to take a comment. This is a live stream, so we're getting a comment that says, do you feel the removal of charges will affect your bank's profit?
On the contrary, we already have 2 months of evidence, and it's much more compelling than we even anticipate. We saw 2 things in those 2 months. First is that the customers that we have actually are doing more with us. That was what we went for. When we removed our charges, our first primary audience was the customers that we have. We liked them, and for them to have stayed with us through difficult times, that means they liked us, and we wanted to give them something, and we're happy we did that. But what we've then seen is that, there's just an upsurge of new to bank. That the number, never in our history as a bank have we acquired as many customers as we acquired in the month of May. Like never, it's never happened before, and it's by a wide margin. So no, there is absolutely no chance that doing good will be punished with lower profit. On the contrary, we are going to see more profit from doing good.
I'm sure that was a shareholder.
We want more shareholders. We'll be coming to the market. I'm sure that when we do begin to show numbers, people would see that the long-term play, the long-term impact-leaning play has its place. And in a place like Nigeria, never before has there been an opportunity for a commercial entity to sort of straddle impact and profit.
Exactly.
And we're determined to straddle impact and profit.
And looking at straddling, your straddling impact and profit, what do you see overall for the banking sector, the industry outlook beyond 2025?
The good news is that I see an environment where inflation will continue to drop gradually and hopefully faster later. And that will translate into some release of cash reserve, which then offers the business. So whatever we lose, due to we're no longer going to have the windfall profit in FX or all of that, we will make up for. Because people forget, we may have had windfall profit, but there's over 20 trillion naira worth of funding from the banking sector that is stabilizing this economy through CRR. That's a big contribution from the sector. And it's not like those deposits came for free. Those deposits are often paid for, and certainly the investment for attracting them is paid for. Those deposits are insured and paid for by the bank. So I often say it's nice to criticize the bank because there are a lot of things we're not yet doing well, but sometimes we need to pause and say there's a lot of good that is coming out of the banking sector. So I was saying that with lower CRR, we could see some growth in assets, and that would feed into profit. The other thing that I see coming is there's been a major push for infrastructure by the federal government. And of course, as you know, with infrastructure development, there's a whole lot of economy that goes with it. I mean, I took a drive after the president commissioned the coastal road. I decided to take a drive, and there is also a huge amount of development involving the real estate economy that is pushing up. There is a school further down the road that used to be an hour and a half called Charter House, and I never wanted to go see it because beautiful building, and I thought I'd love to visit. I didn't go. It turned out that in 20-25 minutes you can now get to that school. These are the things that would drive growth, and then the banking sector would ride on that. But my hope is that beyond us riding on the growth that is triggered by government, I want us to see growth that is specifically triggered by banking intervention. And that's why we do the hard sector. We're very specific in putting capital in places where we are triggering new set of growth and new set of businesses benefiting from that.
Thank you very much for this enlightening conversation. A lot to learn from you, Mr. Abubakar Suleiman, the CEO of Sterling Bank. Thank you for giving us insight into repositioning the Nigerian banking industry to accelerate economic growth. Thank you very much for the time.
Thank you for having me.
It's very nice having the founder, Proshare.
Thank you for bringing me. So it was a nice thing to see Abubakar, because what he's doing is it's actually almost like an old school banker right now in a new age. He's looking at issues about the society, about the economy, and not just about the bottom line. Environmental issues, friendly issues, the creative arts, education. I think that's his number one baby, really. Education, healthcare again. It's an honor to be with you and have the interview. Thank you very much for what you do.
Thank you very much also, Mr. Teslim Shitabe, Director of Research Proshare, for also those very tough but insightful questions. And
thank you very much.
I guess you enjoyed a lot.
Yes, I did. Thank you very much, Otto.
And of course, to our viewers, that will be all for the Proshare Hardfacts edition, which looked at repositioning the banking sector in Nigeria to accelerate economic growth. I believe you learned a lot from this session with Mr. Abubakar Suleiman, the CEO of Sterling Bank. We just also want to notify you that Proshare, just like the Director of Research Proshare had just said, is going to launch its 4th edition of the Tier 1 Banks report. That report is scheduled for Wednesday, June 11, 2025. Time is 11 a.m. But if you want to get further insights on this, the theme is Getting Bigger, Braver and Dominant, the class of 2025. You don't want to miss this session. Log on to our website to get further information on this forthcoming launch. Also, follow our website and our social media platforms to get further insight on our analysis and reports and conversations. Once again, it's been an interesting conversation. I'm Otoba Sebasekon. Thank you for being part of this conversation, and bye for now.